This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HTJ Tax.
Hello, good evening to most of you, and good morning or good day to some of you who may be in other time zones. Thank you for attending our webinar. I'm going to mute everyone if that's okay, because sometimes we get some background noise. And we are actually recording this. So you know how that goes. If you don't want your face to be on the recording that we're making, because some people couldn't make it, please just turn off your video and then we won't be able to see you. Pretty simple. Now, what we're going to do is just talk like we've done in previous sessions. I'm going to talk for about like 15 minutes on the US side, and Damien is going to talk for 15 minutes on the Ireland side. And then that gives us the rest of the time to go through some Q&A. And we think that's super important because we know that's why so many of you are here, because you have really burning questions for which you're looking for some kind of guidance, right? So we want to make sure we devote as much time as possible to that. We did receive, for those who did send the questions through LinkedIn in advance, like we asked, we did receive them. Thank you very much. And we will go through those first. For those who did not get a chance to submit their questions ahead of time, please, there's a box below, a chat box. You can, channel your inner keyboard warrior. Just put all those questions in and we'll get to it in due course. So without further ado, I will now share my screen and run through my really quick 15-minute deck. So my name is Darren Joseph, and I run a semi-autonomous US tax team within a larger practice called Moore's Rowland. So we have probably about 30 offices in 12 countries. I actually sit in Singapore. I'm not in Singapore right now, but I'm based in Singapore. And I've been there for a little more than 7 years now. Now, because I am US qualified, you know how this goes. US is a very litigious society, so we need to be very, very careful. I am not here to give tax advice. I am a tax advisor, but I'm not yet your tax advisor, which means that treat this as an education piece. We're having a general conversation with general principles. If you want, let's call it actionable intelligence relevant to your specific case, you need to engage someone to do that. So I'm not giving tax advice. We're having a general conversation, and I'm not encouraging you to pay less than your fair share of taxes in any jurisdiction to which you are exposed. And that's how I keep my professional liability insurance premiums low. Thank you. And I have it in writing as well, just in case you may have missed it. Please pay attention. I always like to flash these two guys because when people ask, come on, does the IRS ever bother to chase people who are outside of the US? The answer is these two guys, but we can circle back to them if it becomes relevant when we get into the Q&A. What I wanted to do is just go through basic principles. So from the US, as everyone knows, is citizenship-based taxation. And to be fair, well, so is most of the EU, right? So that's not a big deal. The difference between the US and other countries in the EU or even the UK is that in other countries, you have the ability to become tax non-resident. So if you leave Ireland for a sufficient period of time, you'll cease to be a tax resident of Ireland. When it comes to the United States, no matter how long you spend outside of the US, once you hold on to that passport or green card, you are still a tax resident of the US. Even if that green card expires, you're still a tax resident of the US. So I just want to make that pretty clear. Then people ask me the question, well, I'm outside of the US. How is the IRS going to know what I'm up to? The answer is this, FATCA. The Financial Account Tax Compliance Act, what it does, it creates checks and balances. So the Ireland has signed an agreement with the US, which mandates all the financial institutions, I'm not just talking about banks, but I'm talking about all financial institutions in Ireland, to go through their accounts and identify anyone they suspect of being US exposed and report them to the IRS. And I'm sure many of you, just like me, I have more than one passport. That's kind of common these days. So you walk into a bank or brokerage firm or whatever, insurance company, and you open an account or you become a policy holder using your other passport. There is a burden of responsibility on whoever that customer service person is with the financial institution to go through certain checks that they have in their internal policy by law. And if they suspect you are a US person, even if you deny it, if they suspect that you are, they're required by law to report you. And that's how they figure it out. So that's how the IRS may find out who you are and that you have activity going on outside of the US. So in terms, when I say US person, I know I mentioned passport and PRs or green card holders, but there are also situations where people may have overstayed. And that was pretty common last year. You know, a lot of people were impacted by the flight disruptions, the travel restrictions, and they were trapped in a jurisdiction longer than they intended to. That may create tax consequences. Now, the IRS has provided some level of relief, so we can have a separate conversation about that. I also want to call out accidental Americans because we commonly have clients who, okay, one US person marries a non US person. In this case, they marry an Irish national, and there's a child from that union. Even though that child's birth was not registered with the US Embassy, they have no social, they have no passport, they have nothing. They are still potentially a US citizen who will be taxed once they start earning money. And that is um, I mean, as one would imagine, that's a big part of our practice, dealing with these so-called accidental Americans. There's also the ability to make an election under Section 6013G to have your Ireland or your non-US partner be treated as a US person for tax purposes. And if that's relevant, because there's certain tax advantages to that, and it could be part of a tax planning strategy. We can talk about that in the Q&A as well. So, okay, what are your responsibilities? Obviously, the taxes. Now, what is somehow counterintuitive is that when it comes to international taxes, the IRS isn't about collecting money so much as it is about collecting information. And why I say that is because the penalties for not paying or not filing, declaring your income, well, you know, it's interest plus penalties, and we're in a zero interest rate environment. So it may not be a lot depending on what it is. But if you have a bank account in Ireland and you don't report it, that is not just civil penalties up to 50% of that unreported balance, but that's jail time. So you get in they throw you in an orange jumpsuit for not declaring bank accounts outside of the US. And those two guys that I flashed at the beginning of my presentation, that was their situation. One of them used to be my friend on Facebook, and he no longer is because he fell afoul of the IRS. And he's out now, but he's just staying off of Facebook. But it's really important. Please take this seriously. So reporting those foreign accounts are super important, as well as what we call transfer taxes. So there are also taxes on gifts. So like if you give or receive a gift to your non-US spouse, partner, business associate, friend, whatever, that may trigger a reporting, not necessarily a tax, but a reporting obligation. Okay, so I'm gonna jump into this acronym that I think is pretty cool. It helps you understand and remember what your US responsibilities would be. And when I say the acronym I use is BEST, so do your best. B, bank accounts. And remember, the expanded definition of bank accounts would include financial accounts, so brokerage accounts, certain insurance policies, if there's cash in the policy, a cash surrender value, pension funds also need to be reported as well. So report your bank accounts. B. E, estimated taxes. The IRS does not like to wait until the following year to get its taxes. So it doesn't want to wait until April 15th of 2021 to get money owed for 2020. You have to give it in at least quarterly installments. Failure to do that leads to underpayment penalties. So E, your estimated taxes, please remember that. S, state taxes. You have 50 different states, 50 different rules, but most states are domicile states, which means under certain circumstances, even though you've been a resident in Ireland all year long, you may still have state reporting and state tax obligations unless you took specific steps to sever your tax residency in your given state. So remember your state taxes, and then people think, well, I'm going to stay in Ireland. Who cares? The state does have a long memory, and we have many clients who've returned to the US, retirement or whatever. The state recognizes that they're back and they throw a big bill at them because it's gathered interest and penalties over the years. So it could be pretty shocking. So state, don't forget it. Last but not least, your transfer taxes, like I mentioned, your gift taxes, but also, I know it's a bit morbid, but it's something that does bear some consideration, your estate taxes. Again, a part of our practice is estate taxes. You know, that US partner who has married the non-US partner, the US partner passes on, and they leave a huge mess for the non-US partner to deal with because they were not 100% compliant. There was no planning around handling of the estate. So, you know, it's about making sure that your beneficiaries, your family, uh, don't have a difficult time with the IRS on your passing. So something to think about and speak with your chosen advisor about. I just want to run through just a few quick ones on the stimulus payments because people have been asking a lot. So yes, we had the first round last summer and the second round was approved at the end of December, and most of you would have got it already. Once you fulfill those conditions that I have there, you have a valid social, you're not a dependent. Every citizen and green card holder, even those that reside outside of the US, are entitled to it. If you didn't get it, do not fear, speak to your tax professional. You will get a recovery rebate credit. What does that mean? It means that if you were due a refund, it's going to be a bigger refund by the amount of the credit, which would be the stimulus check that you didn't get. And if you have a tax liability, it will be reduced by the amount of the check if you did not get it. So just have a conversation with your preferred advisor, and also have a look at the IRS website. The guys have spent, guys and ladies as well, have spent a lot of time keeping it up to date with lots of FAQs. You can put in your bank details, you can check where things are. So have a look at the website if you have any questions. It's pretty well maintained. Most of our clients are higher income earners, and the first thing they ring me up or they shoot me a WhatsApp, where's my free money? A lot of the time the answer is, I'm sorry, but it's the price of your success. You've earned too much, at least according to Congress or the IRS. So there've been some phase outs. So that's another thing. If you haven't seen any checks, just bear in mind that if you earn above a certain income, you don't qualify for it. So, you know, just something to bear in mind. And for those who, before I get to President Biden, don't forget that the rules around filing do change with time. So some people think, well, you know, I don't earn enough money. I don't need to file a tax return in the US. It's not my problem. If you have a look at this, and I took this out of the instructions for Form 1040, if you're married filing separately, if your gross income was more than $5, a tax return was due. So, you know, think of that. More than $5, a tax return is due. So please double check. Don't assume that you don't have to file. And President Biden. Now, during the campaign, the campaign team released a pretty comprehensive tax plan. It is way too much to go through right now. So I just cherry picked some line items that may impact on expats and international entrepreneurs, right? bear in mind that none of this has been passed or whatever. There's always negotiation, there's always give and take, there's always horse trading in Congress. So it will be changed once it eventually comes out. But what is proposed is a higher tax for those earning more than 400K. So what they perceive to be higher income earners, they're going to be subject to a higher level of taxation. For those who have corporate structures, yes, under President Trump, it came down to 21%. President Biden wants to raise it to 28%. And that would impact and he also wants to impact those that have structures that use lower tax jurisdictions that are subject to what we call GILTI, or the Global Intangible Low Tax Income. Basically, what I want you guys to take away is that if you have a corporate structure, I'm talking specifically to those who run their own businesses. Think of your corporate structure like your car. You don't run your car for months and months and months or years without getting it serviced. You need to have it examined to make sure it's still fit for purpose. Same thing with your corporate structure. Make sure you get it examined to make sure it's fit for purpose, given the rule changes that are constantly happening. So that's just kind of like a taster as to what's been happening. There may also be some downward movement on the estate tax threshold. There's a unified tax credit for gifts and estate taxes. So in terms of planning, now may be the time to get things done before that threshold comes all the way back down. So, and with that in mind, I'm gonna hit the pause button. Please put your comments and your questions in the box below, and I will now hand over to Damien.
Thanks, Darren. Hello, everybody. Damien Malone is my name. I'm the owner of Malone & Co. We're, I suppose, a general accountancy and tax practice based in West Dublin. So I'm just going to share my screen with you here now. Just give me a sec. My first slide anyway, guys, is just to give you an introduction for anybody that would come to Ireland. I suppose the taxes that they will encounter on a day-to-day basis that we have, and really we've 6 main tax heads, and I've also put in what we call the local property tax. So I'm going to give you just a brief summary about what each one is, and I suppose the main points that I would say relevant to each tax head. So the first is our general income tax, and basically that kind of comes in under 3 separate strands, if you like. We have PAYE, we have USC, and we have PRSI. So PAYE is pay as you earn, which really is the income tax. It really should be called income tax. And we kind of have 2 rates of PAYE. So we have a 20% rate and a 40% rate. Depending on one's circumstances, it determines at what point you move from the 20% rate to the 40% rate. And then we have what we call these tax credits, which, again, depending on your circumstances, that will determine what entitlement to these credits you have, and they reduce your PAYE liability. The USC is what we call the Universal Social Charge. This was introduced just after the time of our recessionary years over here as an additional measure to try and raise additional coffers for the exchequer here when we were struggling. There's a couple of different rates at that, and again, it's graduated in line with the more income that you earn. The third one is our social insurance, and it's PRSI, so we call it pay-related social insurance. And again, it's generally, there's different rates of that depending on whether you're an employee, and if you're an employee, how much you earn, or if you're self-employed. But as a general rule, for most of our clients, at the level of income they would earn, it's 4%. And there's also employer's PRSI, where if you are an employee and you don't own the company you're employed by, your employer will pay this separate social insurance, as well as the social insurance that's withheld on your own wages. The corporation tax is obviously if you set up a corporate structure, the tax you would pay on those profits. I suppose, again, most clients that come to us end up running their business operations through a company, because obviously we have what we're well known for, which is our low 12.5% tax rate, which is our tax rate on essentially trading income. So trading income is that of any business activity that you're generally working in, or buying and selling, or providing services, or whatever it may be, as distinct to passive activity, which is really investment. So if you buy a property and you rent out that property, or if you buy stocks and you're in receipt of dividends and so forth, that's considered passive, and that's taxed at a different rate of 25%. We also have a few exceptions to that. So I think, in fact, we have 6 rates of corporation tax in Ireland, but I suppose the only other one I want to mention at this point would be our low 6.25% rate that we call our knowledge development box, which is really a special rate for IP type profits that are generated, where if you come over and set up a company in Ireland and invest into your intangibles or your IP, any profit that's from that, you can potentially qualify it for this low 6.25%. Our capital gains tax is where you make gains on disposal of assets. Currently, the headline rate for capital gains tax for both individuals and companies is 33%. Like with corporation tax, we do have variants of that, and some quite useful exemptions as well for capital gains tax that are geared towards, I suppose, business owners, which I'll touch on later. Capital acquisitions tax is the tax that's imposed on anybody that comes into an inheritance or receives a gift. It's the basis of that tax is on you look to see the relationship you have with the person who you either inherit from or get the gift from. And we have 3 different classes, essentially. And depending on your relationship with that person, that will determine the class that you fall into. Each class has a threshold. And when you go over that threshold, you pay this capital acquisitions tax at a rate of 33% over the threshold amount. So anybody that is going to come into a gift or an inheritance, I suppose we would do quite a lot of planning work around all that to make sure that any tax is kept to the minimum. Value-added tax, I'm sure you all know, is a tax on goods or services within the EU. We've generally 2 main rates of it in Ireland, 13.5% and 21% now, which is the standard rate. So on your day-to-day essentials, you will pay that. You will pay that at source when you at the point of transaction. If you set up a business, you will be obliged to register for value-added tax and charge tax or charge VAT on your supplies to your clients and collect on behalf of the Irish Tax Office. It's not designed to be a tax on business. So when you're in business, you collect VAT on behalf of the government, and you're entitled to recover any VAT you incur in the course of your business. It's really a consumer-based tax. Stamp duty is our tax on the stamping of certain documents and contracts and so forth. So if you come over to Ireland to buy a house, you'll pay stamp duty on the closing of the house and the signing of the contract for it. The rate for stamp duty is generally 1% for residential property up to €1 million and 2% thereafter. It's for commercial property and for other instruments, the rate can be quite higher, and the current rate for commercial property is 7.5%, having been only 2% maybe 4 years ago, 3-4 years ago. So there's been a massive jump in that over the last few years. The last one I have there is the local property tax, where this was a tax introduced again a couple of years ago, where if you own a property in Ireland, you pay an annual tax based on the tax authority's deemed value of that property. So moving on to, I suppose, what determines the charge to tax in Ireland when you come to live in Ireland. And we have these 3 very, I suppose, important concepts in Irish tax law. One is tax residence. The next is ordinarily resident, and the final one is domicile. So to look at residence first. So residence is essentially a days-based test. And if you're in the state for 183 days or more, you're automatically considered to be tax resident in that year of assessment in Ireland. There's a separate provision whereby if you're in Ireland for 2 consecutive years and you're in the state here for more than 280 days, so that would be 140 days per year on annum, per annum, you would be deemed to be a tax resident in Ireland in the second of those years. So obviously, when you're a tax resident, that triggers a couple of things as regards the scope of your income to tax in Ireland. Obviously, any of your Irish source income will be liable to tax, and then when we come to ordinarily resident and more importantly domicile in a minute, I'll explain how that impacts on your foreign income. So the concept of ordinarily resident or ordinarily residence is when you've been resident in Ireland for 3 consecutive tax years, you take up this title of being ordinarily resident, and that has implications for particularly capital acquisitions tax, which is the tax on gifts and inheritance. So more important then again is the concept of domicile. And I suppose one of the features of coming to work and coming to live in Ireland, if you're a non-national essentially or a non-domicile, is you qualify for what we call the remittance basis of tax. So this remittance basis of tax allows you to just pay tax on your foreign income as you remit it into Ireland. So if you have overseas investments or a business overseas that you manage, during the year or whatever it is, you can avoid having to expose any of the profit that you would make on that from tax in Ireland, just with a bit of careful planning. So it's all based around this concept of domicile, and really everybody, generally your domicile in the first instance will be the country you're born in or the country your father was born in. Would generally be the starting point for that. To lose your domicile at any given time is not an easy thing to do. And really what I suppose the case law that's there over the years, what that looks at is, I suppose, the extent to which you're you settle in the country that you take up residence in, and the likelihood of you ever leaving that country and returning home. And because it's quite hard to lose your domicile of origin, as we call it, which is your domicile of birth or where you were born and reared, it's quite easy to plan around that and ensure that you, if it suits your circumstances, when you come to Ireland, that you want to ensure that you're considered non-domicile, you just kind of leave the door open, so to speak, by ensuring that you're living in Ireland, but you don't envisage you living the rest of your days in Ireland, essentially. And I suppose you would do some bit of planning around that just to ensure that your argument would stack up. The effect of it then is it basically applies to both income and to capital. So if you have overseas assets that you are buying and selling and you do make gains from those gains won't be taxed in Ireland unless it's the case that you remit those into Ireland or lodge them into an Irish bank account. So it also facilitates opportunity for, if you have significant capital and significant wealth accumulated before you come to Ireland to take up residence here, once you can clearly distinguish that capital and that wealth was generated before you came to Ireland, you can then bring that money into Ireland. It's really only from the point you take up residence that the Irish authorities would be focused on ensuring that you've declared any such remittances that are liable to tax in Ireland. One final point just on this area is from the inheritance point of view, and again it's slightly different in that in order for a non-domicile person to fall within the scope of Irish inheritance tax, which is the capital acquisitions tax, you generally have to be resident for 5 consecutive years here in the state to be liable for that, unless the person who you received the inheritance from is resident themselves, or that the value of what you've received is what we call Irish situate property, which is essentially land and buildings that are in the state here. So I suppose that it gives you an overview of how foreign income is taxed in Ireland when you come up to take up residence here. So to touch on, I suppose, what your obligations are if you come and live and maybe start a little business in Ireland. So The first thing that you'll do is you'll be registered in the income tax system. So it's quite a straightforward process. It's a self-assessment process. So what you would do is you would come to the likes of ourselves to complete the necessary paperwork and all that, and it doesn't even take a week to get into the system once you have a social security number here, which again we would obtain on a regular basis for our international clients. The year-end tax return is called a Form 11, and it gets filed at the end of October for the preceding calendar year. So in October 2021, we would be filing tax returns for the 2020 calendar year, and on this you declare obviously what your taxable income is. And more importantly, I suppose, and there's been quite a lot of change with the format and layout of the return in the last couple of years. You declare quite a lot of information now about your circumstance, and in particular your residence, your ordinary residence, and your domicile status. So it's important to make sure that whoever is submitting your tax return knows exactly what they're doing with it. We do come across quite regularly people have a go at submitting these returns themselves and think it's quite straightforward. It's anything but. So professional advice is always should always be sought to make sure that what you declare is factually correct as regards your circumstances, separate to any of the declaration and the figures. Corporation tax return we call a CT1, and basically when you incorporate a company, you have discretion to choose the company period end. You would generally do it the end of the 12th month after the company's incorporated, but there is discretion there. Then you file your annual tax return. So if let's say you incorporated a company in January 2021 and your first year end was December 21, your first corporation tax return wouldn't be due until the 23rd of September 2022. And on that is obviously a statement of the company profits and gains that you have to pay your tax on. We do have a preliminary tax regime in Ireland, so it doesn't apply when you come to Ireland for your first year, but every year thereafter you do have to make quite significant down payments in the year of assessment, which are essentially an estimate of what the liability is going to be, or you can choose to pay base it on what the prior year liability was. So it's just important to be aware of that from a cash flow perspective when you've been living in Ireland between year one and year two. If you set up a little business here, you'll obviously have VAT return obligations, and these can be it can be a bi-monthly return, 4 or 6 monthly, or annual, depending on the type of business, the size of the figures, and certain other factors that the tax office look at. For doing a payroll, so if you set up your own business and it's just yourself, you'll have to register as an employer and operate a payroll on essentially any salary that you would take out of the company. Same as if you're employing staff here, you'll file a monthly return with the tax office. We have a new process that we call PAY modernization, where this work is all done essentially in real time. So if I'm making my monthly payment for my wages today, I sync my payroll with the tax office website that we call ROS. It tells me what my allowances and what my year-to-date figures and so forth are, and then the payroll software does the calculation based on the information that it gets from syncing with the tax office's portal. We do the calculation and then we submit the return in real time to the tax office. So it's quite a sophisticated process that they brought in. It's going to be like that for VAT in a very short period of time as well. And it gives obviously the tax office here quite a lot of information and quite a lot of useful data to monitor taxpayers. We do have a fairly heavy penalty regime if you are late with your returns and all of that. So if you're late, you have an automatic surcharge that's applied to the tax that you owe. There's an interest charge that can be separate to that. We have fixed penalties depending on the nature of what gave rise to the lateness or the category of default. If you filed your returns wrong and you owe more than what you filed, it can eventually lead to being published in the local media here, and of course probably not quite as quick to throw on the orange jackets like what they're doing in the US, but nonetheless it can happen over here, although it's fairly infrequent when somebody gets a jail sentence for a tax issue. We were In the content, one of the pieces we said we would cover is the social security system in Ireland, and this is the PRSI system. So as I touched on earlier, we have two strands. So we have employee PRSI, which is if you take up a job in Ireland, you'll pay this on your wage. It's up to 4% on your gross wage, but it can be less for lower earners. If you employ staff in Ireland, and obviously for all Irish employers that do, there's a separate employer's social insurance arrangement. Again, there's two different rates of that, the highest being just under 11% and the lower rate being 8.5%, and that's of the gross wage. So this goes into the social security system in Ireland to fund a lot of the state benefits that people are entitled to from the payments that they make. So if you're in employment, these deductions get paid at source. If you're self-employed, you'll pay those annually on your annual income tax return, along with your tax declaration and your tax liability. We have a number of different what we call classes of social insurance, and again, depending on your status and your circumstances and who you work for, that will determine the class of this social insurance that you pay. So I'm just going to talk about the two main ones, and the two main ones are Class A and Class S. So Class A is generally where you are an employee or you are a director, but you don't have a controlling interest in the company that you're a director of. And this is where you pay employers PRSI and employee PRSI. This is the most generous class in terms of the benefits that it gives. And there's a whole array of them. The main ones that I have listed at the bottom there would be typically job seekers benefit, maternity benefit, and paternity leave, and those type of benefits, and obviously then the state pension. Class S is when you set up either as a self-employed person in Ireland, or you set up a company in Ireland and you have a controlling shareholding or a controlling interest in that. Now, you don't actually pay the employer's PRSI, so there is a saving there, but it doesn't entitle you to the same level of benefit as those that pay in and contribute at Class A. So the difference between the two, I have them highlighted there just to give you an example. You don't get illness benefit, carers benefit, health and safety benefit, and occupational injuries benefit. Up to about 2 or 3 years ago, you didn't get job seekers benefit either. You didn't get maternity benefit, and because of, I suppose, what was clearly a classed as a sort of discriminatory practice or discriminatory regime against self-employed people in Ireland, the government changed that and gave those entitlements to the self-employed. So my last slide, and just to finish up on a couple of points I wanted to touch on that would be relevant, that we would see to anybody coming to live in Ireland. The first is what we call SARP relief, which is a special assignee relief program. This would be applicable if you come over to take a job in Ireland and you're, on reasonably good wages or a salary. This has the effect of relieving you of 30% of your income over 75,000, capped at 500,000, from the charge to income tax. So again, if you're on $500,000 of a salary, it makes quite a significant difference as what the same tax bill would be for an Irish person on the same gross. And again, it was brought in to try and attract, I suppose, individuals of the type of caliber required to manage and set up and lead foreign direct investment type businesses that were coming in. We have a 3-year corporation tax exemption that applies to everyone that sets up a company. This is based on employing staff on the ground in Ireland. If you employ staff, the employer's social insurance that you pay gets credited against your corporation tax bill for 3 years. So again, if you do have a business that you could potentially employ people through, this is a very, very useful exemption that's there that you can save quite a lot of money on corporation tax. BIK is what we call benefit in kind, and I flagged this because it's something that invariably we run into, or we see our international clients running into difficulty with. This is really a tax on any benefits that your company may pay on your behalf, and it's kind of a catch-all It's kind of a catch-all tax, so obviously it applies to the likes of motor vehicles. If your company is paying your private rent and your medical insurance and that sort of thing, there are some exemptions to it, such as if you wanted to come over and drive an electric vehicle, your company can buy the electric vehicle for you or can lease it, and you're not actually caught for any of this benefit in kind tax. Myself and Darren, we had just a quick chat on the differences on pension contribution relief before we went on the call here, and I have it listed here as something to mention. So we would often see, for our international clients that come over to live in Ireland, we would generally set them up in a company structure. We would encourage them to look at their pension provisioning arrangements. We have very advantageous pension arrangements that can be put in place for an owner manager in a company situation, where the company can contribute in a tax efficient manner quite significant sums if the business is able to generate reasonable profits. That is a very efficient way of managing, I suppose, profits that one can generate for themselves. We have two very generous reliefs that are in our system for business owners. They are retirement relief and entrepreneurial relief. And in a nutshell, retirement relief, if you sell a trading business, you can essentially sell it for 750 grand in Ireland and you're not liable for any capital gains tax. Entrepreneurial relief goes a step further, and you can then sell it's where you sell shares in a company. You can sell them for and pay up to €1 million and pay 10% capital gains tax on the disposal proceeds. We would do some planning every so often where we would come across cases where we can utilize both of these reliefs into one case in a staggered manner, which would essentially enable somebody to sell a business, and even potentially a husband and wife, where a business could be sold for 3.5 mil on a 200,000 tax liability, which isn't bad. And that's by obviously where the husband and wife own the business. We're maximizing the retirement relief claim at 750k with no tax, and the next million at 10%. My last point is, in Ireland, we have a very advantageous holding company structure as well. So for international business people that have that are entrepreneurial, I suppose, and have different business interests, an Irish holding company is a very tax efficient vehicle for managing their investments. And the main feature of that is that the investments in trading companies and so forth can be sold free of any taxes and legitimately held for reinvestment in the holding company structure. Okay, that's the end of my slides, guys. So we're happy to take any questions that's there.
So we're back. So what I thought would be good is if, just to acknowledge those who submitted their questions ahead of time, we can just go through the questions that we got. So let me pull those up first. So these are largely around pension. So someone is saying, as an American living in Dublin, married to an Irish citizen, per the treaty, what pension types are considered qualified in either country? Unfortunately, the treaty isn't specific at all. US 401ks and IRAs, are they recognized as qualified in Ireland, and vice versa? From a US perspective, she's absolutely, she or he, whoever submitted this, is absolutely correct in that what is recognized as qualified is defined in the tax code for that country. So in terms of, because what people are essentially looking for is a tax win. So in terms of a relief that reduces your taxable income, contributing to a foreign or non-US, even though it may be qualified in that other jurisdiction pension plan, it won't give you that tax relief. On the other side, when money is being pulled out, if it's from a foreign qualified plan, then yes, under certain circumstances, the treaty would allow for a tax benefit on the US side if you're pulling out an Irish pension in Ireland. So yes, on the withdrawal side, but largely no on the contribution side. Damien?
Yeah, so what we spoke about, Darren, just before we went on the call as well, and the distinction between the two that we can see in Ireland, like this concept of like a qualified scheme or not. Like really every scheme in Ireland is a qualified scheme, like, because it has to be set up in that way. It's not like the example that you made, Darren, where in America, if you have like taken a self-directed scheme and it's investing in stocks and shares and that sort of thing, you're actually paying. It's actually the scheme itself is more or less disregarded from what you said, and you're paying your income tax, you know, based on gains that you've made from that through the scheme. That's not what it's like in Ireland. Once you follow, and once the scheme or the trust or whatever structure it's set up by the pension people is done and is approved by the tax office, it can really invest. If you're controlling it, it can really invest as you see fit within the pension rules. And if it's under someone else's management, they do the management for you and so on. Like they all qualify. The issues, I suppose, from an Irish pension side or an Irish pension scheme side is just ensuring that, I suppose, you don't take away the good of a pension scheme by over contributing and ending up having a fund that's in excess of what we call the standard fund threshold, because it just gets inefficient at that point. So once you plan your contributions and aim to try and project your fund to get it up to a level, if you're fortunate enough, the equivalent of what we call the standard fund threshold, that would be how one would go about optimizing their pension arrangements from the Irish side. But we're not. If you set up a self-directed scheme, as we would encourage a lot of our business owners to do, you can invest in whatever you see fit, subject to the normal pension rules, and it rolls up the gains and the income from that roll up tax free. And there's no, you're not deemed to, it's not considered not qualifying because of what what it's invested in.
Right. So that's great. So that actually flows really nicely to the next question, which is, for whichever Irish pensions are qualified in the view of the US, are you restricted on what investments can be in it? For example, ETFs. So essentially, I think many people would be aware who've had this conversation with their advisors before. There's such a thing as a PFIC, a passive foreign investment company, which is basically a rule that was initiated, I think, in the 1980s to essentially, I'm just going to be completely honest, it penalizes US exposed persons who invest in foreign mutual funds. So that was the intent, because what the US domestic financial institutions were complaining about is that Americans were investing overseas and getting tax breaks. So they flipped it on its head, and it's actually a penalty. You're being penalized when you invest in a foreign mutual fund, regardless of how the mutual fund is disguised. So if you could put it in an insurance wrapper, because some of them, sometimes you look at an insurance policy, but really it's an investment fund. It's tax advantage from a US perspective, in that it gets a PFIC treatment. Similarly with Irish pension funds, and as Damien pointed out, every Irish pension is a qualified pension. But once you have it that's unit linked, or it's invested in stocks and shares, there's a strong possibility that you're dealing with a PFIC from a US perspective, which means it's tax disadvantaged from a US perspective. But that's not to say that you can't do it, because what may be required is, some sensitivity analysis, rip out that spreadsheet and run some scenarios. Maybe the returns on it and the advantage, the tax breaks from the Ireland perspective outweigh the penalties from the US side. So it could still be a green light. You just need to run the numbers and make sure it's the right fit for you. Damien, do you want to comment?
Yeah, so from our side, from the Irish side, really, and we'll take it like if it's a self-directed pension, because obviously if it's not a self-directed pension, you don't have control of where it's going anyway. You can really invest in any assets as you see fit, subject to a few exceptions, such as, like, if you can't buy a holiday home for yourself in it. Obviously, you can buy property as things stand now. There is talk, and there is I don't know, is it an EU regulation or something that's coming in to try and, they're trying to outlaw property as an investment class to be used in self-administered schemes, but it doesn't look like it's going to happen anytime soon. You can't obviously buy assets from people that are connected with you, or family members, or something like that. You can't buy works of art. But other than that, like if it's just, you know, listed stocks and shares, if it's, you can actually give loan notes through your pension scheme if it's on an independent and arm's length basis, and again, not to a company that you're connected with. So there's a whole array of very useful, you know, very useful options that you can have if you do have a pension pot to make use of the money that you have in that pot. And again, it's something that we do a fair bit of work, a fair bit of work with our clients in trying to, I suppose, think of ideas as to how they can leverage that money for their own asset management and asset identification purposes.
Okay, great stuff. So moving on, as an American living in Ireland, it certainly seems beneficial to keep my US domicile for tax purposes. Can a new domicile ever be forced upon someone? What if I, American, continue to live in Ireland for many decades or into old age? Can I still keep my US domicile? So again, we were talking about this earlier. It is a test of facts and circumstances, you know, that drives it. From in the US, and Damien will comment on the case law, but in the US, it's not in any IRS code. So what we do is we need to rely on case law to understand how the courts would interpret domicile. So I've written it sections in my book, but I also have on my website, htj.tax. If you do a search for articles, I have like over 1,000 articles on US tax and friendly jurisdictions that we would deal with. I do quote at least 10 pivotal cases in US tax court, which guide how the US authorities view domicile from a tax perspective. But essentially, just to give you the real quick summary, it's a test of intent plus deliberate action. So what they do is look at, okay, what was your intent in leaving the US to go to Ireland? If it is that, you know, you had a going away party, you broadcasted on Facebook Live, all your friends came over and you said, goodbye guys, I ain't coming back. That's it. I'm gone. Good knowing you. So obviously you display, I'm being extreme, but that is definitely intent to shift domicile. You are gone. Whereas on the flip side, we've seen cases, and cases have been cited in courts where they would fly back to the US once a year, twice a year to see friends and relatives. They maintain membership in certain social clubs. So for example, in certain fraternal organizations or whatever, they maintain their membership, you know, they maintain relationships and they maintain bank accounts, they maintain activity to suggest that it was not their intent to abandon the US on a permanent basis. So it's really a test of fact and circumstance as to where you end up being domiciled, but it should not be left to chance. We would recommend that it's part of a proper estate plan, as I mentioned in my book behind. Because as you would be aware, if it is that you're deemed to be US domiciled through your facts and circumstances test, your assets in Ireland and elsewhere in the world may be subject to US estate taxes. So that is something to keep in mind. You don't want to leave that sort of thing to chance. Damien, over to you.
Yeah, I think that's a very good explanation of the concept of domicile, Darren. And again, the old example that I always refer to is like when it can come down to as much as where do you intend on being buried. And if it's the case you're going to be buried in your country of residence, then a bit like the factors that you had touched on there, it wouldn't be looking good for you in terms of arguing the toss that your domicile of origin remains your domicile. But again, it should be easy enough if your figures and your circumstances are such that you know, you have to, it makes such a difference to you to be non-domiciled. It's generally easy enough to maintain what needs to be maintained, to resist any potential challenge that could be there. I'll just answer one other question I see here. How do I sever my domicile status in my state? So, like, as far as I know, in most jurisdictions, it's again a self-assessment thing, and it's really a matter for each person to their own to determine where their domicile status is. And of course, it's only in the case of a query or a challenge that you may have to account for your thought process and so forth with it. So I suppose if your figures are such that to change domicile is merited, plan early and take the right advice, and you probably won't go too far wrong.
Okay. Moving on to the next of the pre-submitted questions. Irish pensioners often have the option to take a large lump sum, tax-free retirement. What would be the implications from a U.S. perspective? Well, with the pool of funds in the pension, some of it would be potentially already taxed, depending on whatever the fund is. So from a U.S. perspective, remember, you didn't get a tax break and put any money into the Irish qualified pension plan. So the initial investment would have already been taxed, or what we call the corpus, the original investment. The returns on that investment may not yet have been taxed. So therefore, what is required when you get that 25% or whatever distribution, we would potentially need to bifurcate the sum coming out and assess what percentage of that represents previously taxed income, and what percentage of that represents a return on it. And then the tax would be a tax on the return on your investment. Damien?
Yeah, so in Ireland, obviously, yeah, you can get 25% up to a limit out tax-free, subject to having I suppose, a guaranteed minimum income level, based on your other assets and your other income streams, and if you qualify for a state pension and the likes of that. What I'd mention as well is you can plan as part of your estate planning process, like using a pension or using pension wealth can be done quite tax efficiently as well, and it might alleviate the need for that question in the first instance if you're sufficiently wealthy enough to have enough of a means to pay your livelihood or to pay your living expenses in your retirement years. You can essentially leave, so when you reach a certain age in Ireland, your pension pot can turn into what we call an ARF, which is an approved retirement fund. Generally, the ARFs can be transferred to your spouse free of tax. So again, it might be one way of managing your estate quite tax efficiently, rather than triggering upfront taxes in the US by virtue of US citizenship by taking periodic drawdowns out of the pension pot.
Okay, and the last of the pre-submitted questions was, do we need to routinely notify the US Social Security Administration or on the other side, the Irish state pension, about living and working in the opposite country when it comes to contribution credits, or are they automatically noted because of the totalization agreement? From the US perspective, this is really a situation when someone is self-employed. So if someone is self-employed, a US person being self-employed in Ireland, typically they'll be subject to the same 15.3% self-employment tax as they would be subject on US soil. But because of the totalization agreement, once you're making the requisite contributions to Ireland's Social Security Fund, you would be relieved of the need to duplicate it by contributing to US Social Security. And how do you notify the IRS that you're doing that? It's on the tax return itself. Speak to your tax advisor, and they make a note on the tax return stating, because once they see the Schedule C being triggered, the IRS is going to look for the self-employment tax, but a note on the return lets the IRS know that a contribution is already being made to Ireland, so no need to look to levy the 15.3%. Okay.
Yeah. In Ireland, yeah, it's on a paid basis. So as we mentioned about the payroll, with the PAY modernization process, so your contributions are paid on a live basis if you're an employee or a director of a company. If you're self-employed, you pay them manually. So it's a self-declaration. So I don't think in Ireland the Irish social security system would be aware of what you're paying in the US. But if it's a case when the time comes that you have enough contributions in Ireland, or even if you don't have enough and you want to make what we call voluntary contributions to give yourself entitlement to a state pension in Ireland, there's a process you would go through at that time where they would review and assess the actual contributions that you've made per the Irish social insurance system. they give you the option then to buy up contributions sufficient to give you the state pension benefit. I assume it would be in that context that the query is asked, and it's nothing to do with the other benefits that we would have.
Okay.
So that's my take on that one. Yeah.
Okay, I know we're slightly over, but just relatively few questions were submitted in the chat box, so we can go through them quickly. The first one was about the streamlined procedures. So this applies to someone who has not been 100% compliant from the US side. And what the IRS does, it says, if your non-compliance was non-willful, and again, that's not defined in code, so we use case law to understand what they mean by willful versus non-willfulness. Once your non-compliance was non-willful, so therefore you didn't deliberately set out to deceive or to evade taxes, then they allow you to play catch up. No matter how long you have not. I had a client this earlier today. He hasn't filed taxes in a really long time, at least not complete returns. But the look back period is only 3 years because that's the statute of limitations, 3 years. So you filed 3 years returns and 6 years FBARs, which will be the foreign bank account report. And the IRS agrees to turn a blind eye to everything that happened before that. You pay your interest, but no penalties, which is super important because penalties can be pretty draconian. So that's how the streamline works. And you draft a statement that explains the reason why you're non-compliant. If this is something you want to discuss further, please feel free to contact me. My colleague Hannah included my contact details above. So please reach out to myself or Hannah, and we can arrange a quick consult over Zoom to discuss that. Next one, how do I sever my domicile status in my state? 50 different states, 50 different rules. But most states, as I mentioned, are domicile states. And it's not really enshrined in any state statute. So again, we have to rely on case law. And you're looking at a test again of intent, basically. So what we recommend, so I had a client earlier today wanted to make sure he cuts ties with California. For those who aren't paying attention, California has been discussing the implementation of a wealth tax, like in Spain and some other European countries, and knowing California and how they've dealt with taxes in the past, it could be retroactive. So we're advising all clients with any sort of connection to California, just as an example, to make sure and cut all ties. And what do we mean? Register to vote, shift your voter registration to another state. Your hold mail, have no hold mail in California. Give up your California driver's license. Anything, if you have bank accounts in California, close them, shift to the same bank, another state. Give California no excuse to tax you. So there are 8 states, as you're aware, that have no personal income tax, Alaska, Nevada, Texas, Florida, which is my home state. So choose one of those states and basically plant a flag in one of those states so that your Californias, your New York can't somehow get a little bit grabby with your assets and your income. So please, if you want to discuss that further, just reach out. Now I see 2 more.
Take this one, Darren. So
Yeah.
For a non-domiciled individual in Ireland who is here longer than 5 years, is CAT the only tax that becomes chargeable on worldwide gains? Others are fine as long as nothing is remitted. So just the wording on that is probably just not correct. So
Okay.
CAT isn't liable on worldwide gains. So a gain is distinct. A gain is when you make a profit on disposal of an asset under Irish law. Like CAT relates to a gift or inheritance. So that's if you receive a gift or inheritance. And yes, that would be if you're resident here for more than 5 years, you would be liable to CAT at that. But obviously, if you know you are going to come into either a gift or an inheritance, you can do some, a fair degree of planning around all of that to minimize the exposure there. From a capital gains tax perspective, which is a gain on asset disposals, yes, if you're non-domiciled, you're only going to pay capital gains tax on worldwide gains that are remitted into Ireland or on gains from what we call specified assets, which again is typically land and buildings in Ireland and that sort of thing.
Okay,
yeah.
Wonderful. Thank you very much, everyone, for attending and for your attention. and for your really thought-provoking questions. We enjoyed answering them for you. If you want to find myself, I'm HTJ.tax. All my contact credentials are there. Damien, how do people find you?
So they can find me through LinkedIn. I'd be delighted to connect with you guys if you want to send me a connection. Our website is www.maloneaccountants.ie. I'm Damien, D-A-M-I-E-N, at maloneaccountants.ie. And if you have any questions or you want anything to run by me, please don't hesitate to drop me an email.
Okay. On that note, thank you very much. Have a good evening, everyone. Bye-bye.
Here are 4 ways we can help you. Number 1. Sign up for free webinars on U.S. expat taxes and international entrepreneur taxes at www.htj.tax. Number 2. Stream premium educational videos at www.htj.tax. Number 3. Contact us for tax optimization consult over Zoom. Number 4. High net worth. We can quote for doing your U.S. international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.